The four most dangerous words in investing are, it's different this time. So John Templeton. Welcome to the Retirement Answer Man Show. My name is Roger Whitney. This is the show dedicated to helping you not just survive retirement. Even in a pandemic, we think you can rock retirement if you take good, intentional actions. So we are continuing our series on retirement assumptions this month. And today we're going to talk a little bit about your market assumptions, your return assumptions. What are you going to earn on your portfolio over the 20, 30, 40-year time frame that you're having to plan for? These can be important. So we're going to dive into that in our main segment. But first, let's talk about what capital market assumptions even means.
Huh? What does that mean?
Capital market assumptions. These are the assumptions that investment managers or asset allocation software uses to design your pie chart. It's going to include three things. It's going to include what the expected returns are for each asset class. And that could be very simple, cash, stocks, bonds, or it could be very complex, large cap growth, large cap value, international small cap, all sorts of things. But whatever asset classes are in the engine that creates your allocation, your pie chart, behind that pie chart, the ingredients of that are what the return assumption is for each one of the ingredients in your pie, what the standard deviation is, which is basically a measure of volatility or variability around the average. And we'll talk a little bit about that. So how volatile each ingredient is, and then how each ingredient is correlated to each other, how they interact together. Those are the three main inputs. And those inputs seem pretty basic on the surface, just like a lot of ingredients in a pie. You got your return assumption, your volatility assumption, and your correlation assumption. But as humans do, we tend to want to manipulate them and put our views on top of them. And that can sometimes be helpful and sometimes be hurtful and sometimes just be a big waste of time. But essentially, capital market assumptions are the ingredients of your asset allocation pie. That's how that pie gets made. So with that, let's go talk about return assumptions in retirement. It's different this time. When I hear those words, I don't care how dangerous Sir John Templeton thinks those words are in thinking that it's actually different this time. He's not around. He's never lived through a pandemic. Dude, it is different this time. When we look at the economy, if there is much of one right now in a shutdown, and I'm talking globally, and we look at the world and we look at the pandemic, it's very easy to make a case. I don't know how all this works. I don't know where we get back to any kind of growth. It's different this time. And so when we're making return assumptions for our modeling, the pull to want to tweak them to the situation on the ground is very, very, very strong. And I don't use very 3 times very often because it's different this time. The hard part with that, though, is we've lived through it's different this time many times. They rhyme. They're not exactly the same. They're all different, but they rhyme in a lot of serious ways that we need to acknowledge. As different and unusual as extraordinary as the pandemic feels, we've had other extraordinarily different events and seasons. Think of, we've lived through 2 in our adult life, at least. We had the Great Recession of 2008. That was very different. From an investment community standpoint, it hit hard and it changed a lot of paradigms of, wow, this system could easily break. It almost went down. I remember being at a luncheon at the Dallas Fed and speaking with someone that worked there and just table talk. And it's like, I was asking him and he was like, we thought this thing we didn't know what was going on. We were just flying blind, trying to navigate, not allowing the whole economic system to collapse. It was different this time. Now, publicly, we had portfolios obviously go down and there was that stress and people lost houses, but that's not like a pandemic. Pandemic is very personal, from the health and the safety of family and the consequences there to everybody affected or not by the actual virus is impacted by they can't go out, they can't go to work, they can't earn living, cash flow and everything else. It's personal this time. So in that sense, it's different. But in 2008, it felt very different too. And coming out of 2008, market assumptions were all over the place because we can never go back to a good economy or a good market after that. Then the other one I can recall living through in my adult life was the new economy of the 90s. That was a different kind of different. That different was on the upside. This is the internet, dude. Valuation matrix don't matter. Earnings don't matter. Your market assumptions and returns are lame. It's not 10%. We're going to average 20% a year. The leverage that the economy and this internet thing provides, it's all about leverage. And hence the investment crowd went because it was different. And you were lame if you were a true value investor or not overweighting buying technology stocks. We can laugh about it now, but if you live through that, in my view, I lived through it and dealing with lots of different views on it. Trying to be reasoned was very difficult then, just like trying to be reasoned was in the Great Recession and, well, now. And then if we look back at history, we forget there were a lot of very different, extraordinary events. We had the Cuban Missile Crisis, the brink of nuclear annihilation, the Kennedy assassination, the Tet Offensive in Vietnam. We had a meetup in the Rock Retirement Club where we were discussing and examining assumptions, which was really productive, by the way. And there were members that remember in elementary, high school, every day practicing going under their desks in the event of a nuclear attack. So is it different this time? It sure is. Question is, what do we do about that with market assumptions? And are we willing to make decisions off of however we tweak market assumptions because it's different this time? So if I were to ask you, let's talk about stocks and we'll focus on the S&P 500 here. If I was to ask you, what are your assumptions of what the stock market's going to do going forward? What would you say intuitively? Would you say the long-term average of 10%? Would you say 0, 4, 5, 6, 7? What is your intuition on what you expect stocks to return going forward? If we look at the data and we look at what the average returns are, because we're going to have to make that assumption for stocks in whatever kind of model or spreadsheet you're using. In the last 5 years, it's been 7.7% average, and this is according to Dimensional. In the last 10 years, it's been 13.3% average return. I want to stop on that one for a second. So that's 2009 to 2018, average 13.3% in the S&P 500. This is a difficult thing to do. Put yourself back into the mindset of January, February of 2009. If you recall, 2008, markets were S&P was down about 34%. In the first 2 months of 2009, the markets were down another 24% or so. March 9th of 2009 was the low. So if you were asked this question, okay, what do you think the returns of the S&P 500 will be over the next 10 years? In February of 2009, when you just saw markets go down by 50% almost, I don't know who would have guessed 13.3%. I think that's interesting because we have a lot of biases around this stuff we got to be careful about. And then if we go out 15 years, it's 8.4. That starts to incorporate the lost decade. We go out 20 years, the S&P returned 6.1% per year. 50 years, 9.7. 80 years, 10.7%. So long-term average, we'll call it 10%. So do you use that as an assumption? It's the historical data. So at least we have something, and that incorporates all of these extraordinary events that have happened over history. Let's make the case. Okay, we're going to use historical data and we're going to use 10% for equities represented by the S&P 500. Now we have to be careful with that, right? So if we look at the last 94 years of the S&P 500, it's been averaged about 10% per year. So that's a good average return. Let's just say that's correct. Well, if we look at the past 94 years, annual returns came within 2 percentage points of the long-term average, meaning 12% to 8%. Well, I guess 9 to 11, in just 6 of those 94 years. So the average was 10%, but you only hit within 2 percentage points of the average in 6 years of the last 94 years. We've had returns that have been positive 69 times, and we've had 25 times that they've been negative. And there are some big swings on either direction, but the skew is too positive. That's important in this discussion because you may assume an average return, whether it's stocks or some mixed portfolio. If you use a calculator or a Excel spreadsheet to do your planning, and you use an assumption, your assumption in that calculator is going to be linear, right? If you assume, let's say, mixed 5% return, it's going to assume you get 5% every single year compounded, and your withdrawals and all the other inputs you have will work off of that. So it's very easy if you do that. And in a spreadsheet, that's sort of what you have to do, because it's going to ask you in a calculator or in a spreadsheet, what is your return assumption? It will likely drastically overestimate the viability of your plan because you have a consistent return that's compounding. And even if you say, well, I'm going to discount my return to try to account for that, you're still likely to skew to the overestimation just because of the power of compounding over 30 plus years. This is where averages really fall apart. Averages really end up meaning nothing when it comes to investing in retirement. Now, it can help you in the accumulation stage because you have money flowing in and you have such a long period of time frame. But if you're investing at age 60 and you assume you're going to live to 90, the first half of that is going to be the most important. So really your investment time frame, it's going to be about the sequence of returns that you get and the consistency of returns over whatever the average is because of the introduction of cash flows and pulling money out. Now let's look at bonds. Bonds, we'll use long-term government bonds to be the representative of bonds here. In the last 5 years, 2014 to 2018, bonds returned 5.6%. Last 10 years, 3.7%. The last 15 years, 5.8%. If we go long-term, and we're just using long-term government bonds, the average return of long-term government bonds have been 5.6%. Now, we can quibble whether that's high or low, but that is the average. And there's also volatility around that average. And right now, the this time it's different view is we're at almost 0% interest rates. Interest rates have no room to go but up. And bonds don't do well when interest rates go up. So we can skew our expected returns for bonds. That may be reasonable. And we're going to talk about expected returns. And right now we're just looking at historical returns. But we got to be careful if we tweak that, because I remember 20 years ago, back when I used to trade and speculate a little bit more, placing bets on interest rates going up because they were so low. And this is 20 years ago. That argument that interest rates are going to be going up has been around for, 20 years that I know of anyway. So we just got to be careful about that one. So we can use the historical rates of bonds at 5.6%, stocks at 10%, and cash at long-term average, and cash equates to, say, 1-year treasury bills at 3.6% over the last 80 years. That's the historical numbers, but we have to make sure in our models we factor in the lumpiness of returns. We're never going to get the average, but I think I use historical numbers. I may not go back 80 years, but I use historical numbers, and I don't spend much of any time thinking about tweaking them. Now, there is a school of thought that you take these long-term averages and you adjust them and forecast what the forward-looking expectations are for investment returns based on, name your matrix. Some people will use adjusted price to earnings ratios. There's a Shiller index that does some adjusting for what true earnings are. They'll look at all sorts of valuation matrix. And then, these are very, very sophisticated models that Shiller and GMO and others put out, BlackRock, to look at all sorts of asset classes and based on their matrix, decide what forward-looking returns are. So if we look at GMO's real return forecasts are for 7 years, because they put out a 7-year asset class forecast, and I'm looking at the one from March 31st, 2019, their 7-year average return forecast for large cap stocks is negative 4.2% per year. Woo. Bonds, U.S. government bonds, 7-year forecast, negative 1.1% returns. Emerging value stocks, 7.4% returns. Emerging stocks in general, 3.4% average return. International small cap, 1.3%. And GMO, by the way, Jeremy Grantham, highly respected in the industry, very analytically sound, and their forecasts are read by everybody in the investment community, a lot of very serious asset allocators. So they're not an outlier. These are very reasoned forecasts that are very different than the long-term averages, and they base it off valuations and everything. So the question is, if we're going to adjust our return assumptions, we have to be using GMOs or just using your intuition or your advisor's intuition. We're going to have to live with the consequences of those assumptions because they're going to influence how we actually invest. So let's take GMOs as an example. That means your portfolio construction is going to be very different. I don't know if you're going to own US large stocks. I don't even know what to do with this. It looks like cash has a 0.5%. So maybe I own cash and international and emerging assets. That's, I guess, what you would do with it. Why would you own large stocks if you're agreeing with the forecast of negative 4.2% a year? That's the difficulty when we're putting our adjustments to what historical data is. I'm not saying historical data is perfect or even accurate. It's not. But do we want to introduce another level of automatic inaccuracy that is going to drastically impact our retirement decisions? This is getting a little nerdy here, but it's an important question to ask yourself. What I have found personally that works. So I don't look at forecasts. I don't use them. I don't look at them. I use a form of historical data for the asset classes and the standard deviation, the correlations, and I build portfolios based off of that. And then I just revisit them often, because if performance is off of average, which they're always going to be, you just make lots of little adjustments to the entire model along the way. So if you were to draw this huge circle, and this is part of the reason for it, is you don't want your retirement plan to hinge on your investment assumptions being correct. You don't. Investment, if you draw this huge circle and then you draw a tiny dot inside that circle, that tiny dot will represent your investment assets. You have a lot of other things in that huge circle that you have control over. And we're going to talk about next week. How do you make assumptions and what should you actually focus on? So I guess my main point here is when we're looking at whether it's inflation assumptions or asset return assumptions, we need to be aware of them. We need to make a decision. We got to be careful about this time it's different thinking, because if you think the economy is dead in the water forever, you're going to have to make investment decisions based off of that, which a lot of people did in 2008 and 9, and they missed 13.7% a year for 10 years because they were wrong in their assumptions. And there are people that never got back in the market. And then if you're wrong, then you got to make all these decisions of when do I get back in? And if it keeps going up, you feel like you're chasing something you should have gotten onto. It ends up leading to a lot of decision trees that aren't really going to make a big difference in your life if you've done all the other planning correctly, and it ends up being a waste of time. This is my opinion. But next week, what we're going to do to finalize this series is talk about how do we deal with all of these assumptions, life assumptions, spending assumptions, and market return assumptions, so we can make sure we're focusing on the things that we have the most control over and that can have the biggest impact in our life. So with that, let's go chat with Nicole and answer some of your questions. And here we are in our question and answer session where we answer your questions. And Nicole and I have been laughing for about 5 minutes now because one is we're trying to figure out how to pronounce our first questioner's name. And
sorry in advance.
We're trying to figure out, it's a multi-pronged question and we had some confusion. Should we answer it all at once or in pieces? This is how the sausage is made. So how are we pronouncing our first questioner's name?
So I'm going with Luce. Not sure if that's how to pronounce it. And if it's not, apologies.
And it could be?
Luis? I'm not sure.
It's important that you pronounce someone's name correctly.
It is, but I'm not sure.
Yeah.
But I am sure that your podcast has been tremendously helpful in helping them plan for retirement. That's what it says.
Well, thank you, Luis.
So it says, I just retired at 50 and I want to plan for Roth conversion in 2020. I have one old 401k account from my previous employer and 2 old 401k accounts at Fidelity. About 60% of my investments are at Vanguard and the remaining 40 at Fidelity. My questions are,
Number one.
Ready? I'm doing this one at a time.
Okay.
Number one, should I consolidate all my investments in one brokerage house like Vanguard, or should I not put all my eggs in one basket?
I would favor consolidating your assets on one platform as much as possible. I think it's important to be very consistent and focused, and adding additional platforms can complicate that unless there's a really good reason to have it. And in terms of putting your eggs all in one basket, I interpret that as, is it less safe to have all your money at Vanguard or at Fidelity or at Schwab or someplace else? And I would argue, no, it's not less safe. They all are very well-run companies. There's insurance in the background. Your account is your account. So I am very much in favor of having all of your assets in one place if it helps you manage things more efficiently.
Question 2. Do I need to roll out all 3 401k accounts into an IRA rollover account before I can do any Roth conversion this year?
So if it's all pre-tax dollars, Luce, it really doesn't matter. You can convert them all over to a IRA and then do whatever conversions you're planning on doing for this year or whichever year you're thinking of. Now, if you have post-tax dollars, because some 401ks allow you to contribute money to a 401k on post-tax dollars, meaning that you don't get the deduction. Usually you do that because you've already filled up the deductible part of the contribution limits. If you have post-tax dollars and your 401k allows you to roll just those post-tax dollars out to your IRA, I would do that first. And then you can go back and roll out other dollars. I think we covered this on a previous question in a roundabout way. But it doesn't really matter if it's all pre-tax dollars. You can get all of those into an IRA and just roll those over to a Roth in any way that you want.
Number 3, I hold employer stock in 2 of the old 401k accounts. I'm considering using the net unrealized appreciation tax strategy. If I do the NUA transaction, I may not be able to do Roth conversion this year due to the tax hit. How do I know whether to prioritize the NUA transaction over the Roth conversion? Also, are there any pitfalls I need to consider with NUA?
The question you pose is a question that comes up all the time, not so much in regards to NUA, net unrealized appreciation, but which should I prioritize? Do I do A or do I do B? Because we're trying to gauge the impacts over sometimes 30, 40 years. So the answer really needs to be in modeling them side by side. So option A, I do the net unrealized appreciation. I take the assets, pay the tax, and then I save the tax. I can pay capital gains when I liquidate the stock after 12 months, which is what you'd want to do. Or do I do my Roth conversions? And you have to look at them side by side. So it's very difficult to answer here. I would map each out. But with NUA, it really is going to depend on how much money are we talking about? What is your cost basis in the stock? And how much do you own? Are there enough zeros at the end of it to really make a big impact? I would argue that you might be able to do both, right? So if you're thinking of, you might lean towards doing the NUA if the numbers were big enough, because you can get that done this year and then you can do your Roth conversions next year. But the NUA is going to help you start the cost basis clock to getting to being able to sell them as capital gains. So I might lean that direction, but you really got to model in both directions. So I don't have clear insight for you, but that's my thoughts on it. That's what I think as of now, which may not be as helpful as you hope. So I'm sorry about that.
Our next question is from Frank on mortgage qualification. Assuming one has a pension, yes, or other guaranteed income and considerable assets, have you found that qualifying for a mortgage while retired is a problem? Rather than pulling out a large sum from retirement investments, we might want to spread out the payments. In our case, we have a paid off residence and can use the rental income to pay the mortgage.
Frank, this is a really good question because this is a problem a lot of people have when they lose income, because the mainstream mortgage industry works off of formulas based off of income and percentages of mortgages to income. And you also have that consideration of being a fan of being very debt-free in retirement, which I am, when a lot of your money is in IRAs or 401ks. Debt can be really bad, especially early in life. But it also can be a tool if it's used prudently. And when you're dealing with multi-year tax strategies and having to realize income when you have control over that, it's important to consider. It goes back to Luce's question of you want to model them. And then also you want to look at your personal preferences and principles when it comes to use of debt. But it's getting easier for retirees, but it's still a bit harder. I've had instances where mortgage companies have required that distribution start just to show a few months of income coming in to be qualified, and then they don't care if you turn it off again. So there's some of these games that some mortgage companies play to help fill their file so they can fit it into their model of doing things. But there's manual and semi-manual underwriting that some mortgage companies will do that you can do to not have to play some of those games. And basically what those are is when they're taking a look at the entire picture in determining whether to grant you this loan or not. But many of them are going to want to have income, but you may be able to play some of these games where you're turning on income for a while, then they don't care when you turn it off afterwards. I'm not necessarily suggesting that to even make sense to me, but that's just how the system seems to work. There was one time, this was right after the 08 crisis, where I had a client who was buying a home, really expensive home, and they could have paid cash for it 10 times over, but they didn't have the income to qualify for the mortgage that they wanted because they wanted to use a mortgage. And it just seemed crazy. Between cash and liquid investments, they could have easily bought this thing, 10 of them. And they had to go find a mortgage company that would do manual underwriting that actually, it was relational. It wasn't simply going online. Now, one last comment on that. I beg you not to go chasing rates in online with firms you have no clue about. I've had clients that have done this, and it can lead you down very aggressive people, very rude people, a very difficult process because it ends up, I'll call them mortgage mills. Once you get into the mortgage mill system, they have your name, they have your email, they have your phone number, and the process can be horrible. Not only that, they have information that if they're not good stewards in how they treat you, they're not likely going to be good stewards in what they do with the information they have on you. So my suggestion would be is to go to reputable firms or local, even if you have to pay a little bit more, because it's going to be worth it, because it can get really bad. I've had some really bad experiences with mortgage companies that are just random ones online with teaser rates.
So is it probably too soon to tell how this pandemic stuff is going to affect mortgage firms? Right. I mean, I haven't really heard anything
as far as
making it more difficult or less difficult, or as far as the process or paperwork.
That's a good question. I recently closed a HELOC on my house, a home equity line of credit, just because I wanted to have it open. And we bank with a local credit union, and it was really easy.
See, ours, when we did it back in November, because my husband was switching jobs and is the primary wage earner, I felt like we had to do everything but like sign in blood in order to prove that we were able to move and the income was going to be there and all that. Yeah.
And this is what Frank is dealing with. So I think the more you can deal with people where they understand the situation and there's some kind of relation, the better. Like that's one reason why I choose to work with a credit union locally. One is I have some views on big banks, and that's a whole different axe I have in my bag.
I didn't even know this about you.
We'll reveal that at some point. But anyway, and we also did a mortgage with a company in mid-cities here in the DFW area. And there are some of these all around the country where they underwrite every mortgage manually, meaning they don't just throw it into some system, and they never sell the mortgage. Because most mortgage companies, as soon as you
sell it,
they sell it and it gets bundled up, and all of a sudden you're paying Wells Fargo rather than the bank that you were paying. And they actually keep the mortgages and service the mortgages throughout the life of the mortgages. And so you're dealing with people. And that comes in handy.
That's nice, though. I will say, from having to deal with phone trees and all kinds of nonsense with software and things like that, just dealing with actual people is nice.
Yeah. And I think, and we try to be that way with clients, right? Is we're going to make mistakes and we're going to do things well. But when things go sideways, you have two people that are trying to get to good solutions together. That works out a lot better, almost always.
Our next question is from Kevin.
Yo, Kevin.
Early this month, a listener asked an audio question about withdrawal strategies and posed his theory with a 60-40 split: withdraw from the stock account during bull markets and from the bond account during bear markets as a method to allow stocks to rebound. This is something I wondered about myself, and I don't recall it being specifically answered. My apologies if you did. I listen to the podcast on NYC subways and sometimes miss a section or two. Thanks for the knowledge, Kevin.
Hey, Kevin, this sort of goes back to the question that we answered last week from Gray in regards to withdrawal strategies and asset dedication. I'm not a big fan of withdrawal strategies in retirement where everything's invested, let's say in your example of a 60-40 split. And when good markets, you take money out of stocks. In bad markets, you take money out of bonds to allow it to rebound. Essentially, and my assumption in that is that you're doing that to provide yourself income. Now, that's what you do when you rebalance. Even if you have a 60-40 and you have stocks outperforming, you're going to sell those to buy more bonds and vice versa. When stocks are declining, you're going to sell your bonds to buy more stocks. That's just normal rebalancing. But when you bring in the idea of withdrawal strategies to provide for your financial life, I'm much more of a fan of asset dedication, meaning you're going to pre-fund your life for the next 3 to 5 years. And then you can have a 60-40 portfolio where you're not even trying to worry about withdrawal strategies. You're just trying to grow that to provide for your life in 5 years plus or 6 years plus, depending on what time frames you set. So I'm not a big fan of withdrawal strategies. Essentially, what you're talking about is a rebalancing strategy, but by just taking the money out to fund your lifestyle. I just don't like it. I think it's great for statistical models, but it's going to interject a lot more uncertainty in life and make it a lot more, it's not setting everything up statistically for success in my view. Did I answer that, Nicole?
I think so.
Okay, let's go to the SMART Sprint.
On your marks, get set.
And we're off to set a SMART Sprint that hopefully you cannot do in your home. Maybe you're opened up by now, that you can take over the next 7 days to walk that journey to rocking retirement. So in the next 7 days, I want you to re-examine your market and inflation assumptions. And this incorporates withdrawal strategies. So it relates to Kevin's question of what is your assumption how you're going to do this and what return and inflation assumptions are you factoring in, because they can lead you awry. So I want to make sure that you just do it thoughtfully. It's the middle of May. That's all I got to say.
Does your shirt say excuses don't build empires?
My shirt does say excuses don't build empires. It was given to me. It's not my motto.
Oh, okay.
Yeah, not my motto. I'm not trying to build an empire, and I'm full of excuses.
You're not going to have a retirement answer man empire.
No, not by design anyway. But what is your motto? Do you have a motto?
Motto?
I have one.
Okay, what's yours?
Huzzah!
Is that a motto?
Yes.
Okay.
Huzzah is, well, define motto for me. What is a motto anyway?
I don't know. I feel like that would be like a saying that you live by.
I live by huzzah.
Okay.
It incorporates embracing life, making lemonade out of lemons.
I like it.
You can have a one-word motto.
You could. If I had one, I think it would be generous. And I mean that in like be generous in assuming people's motivations, like give them the benefit of the doubt, like not just be generous with money or something like that.
My guess is that your motto is going to be grammar.
Grammar?
Because you're very grammatically correct. Oh, always.
Well,
nobody ever emails saying Nicole is using a word incorrectly. I get that all the time.
I use words incorrectly sometimes. I stumbled over that one when I was reading that question.
We're so happy that you get to join. I guess this is a quasi after show. We're just talking. I would be interested in what your motto is. Maybe we put that in 6 Shot Saturday this week. We can get people's
Sounds
mottos. All right. You have a great week. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Would not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize it's helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.